encouraging progress. I'm equally excited, if not more excited, to have with Prateek and me on the panel today three exceptional leaders. I have Rahul Singh, who has taken over the role of Chief Operating Officer, Corporate Functions, which includes people, IT, marketing, risk and compliance, and administration functions. Rahul takes up this role after being president of our global financial services business for almost a decade. Also joining us today is our Chief People Officer, Ramachandran Sundararajan, or Ram, as we popularly call him. Ram has been a veteran at HCL Tech. He's taken over this role after heading the Americas HR for many years, as well as being the head of global GTM HR leader. He's been an integral part of conceptualizing and development of our recently launched employee value proposition, which you will hear about later. I would also like to thank Apparao, who's been our CHRO for the last 5 years. He's moving on into a very exciting and a new role. During the last 5 years that he's been the CHRO, we've grown tremendously, both in terms of people, employee experience, and the geographic expansions. He's been a great contributor to our business progress. He's compassionately steered us through some of the most difficult challenges that we've seen in the world. He will now be taking on a very new responsibility as the Chief Delivery Officer for Nearshore. Nearshore is a very important strategic priority for us, and Apparao will lead this as a Chief Delivery Officer. Jill Corey, our Chief Marketing Officer, is also here with us today. Jill and her team have been instrumental behind this amazing brand transformation, articulating our purpose, new positioning, all of that, and you will hear from her a little later. So with that, I will go to the headline performance. It's been a stellar quarter on all fronts. I'm happy to report that we've delivered a strong performance of 3.8% constant currency sequential growth and a 15.8% constant currency year-on-year growth. The icing is the services business continues to deliver very strong numbers, growing at 18.9% year-on-year and 5.3% sequentially in constant currency. The growth momentum has been led by both our engineering and R&D services and our IT and business services, which is our digital business, digital foundation, and digital process operations, which continue to see the market trend of technology-led business model transformation, which is where we are winning significantly. Our products and platform business, now rechristened as HCL Software, degrew 7.8% in constant currency sequentially, which was expected because it was seasonally a weak quarter. On a like-to-like basis, if I take out the divestment that we did, then it degrew about 2.7%. As I said earlier, our margin performance has significantly improved. We did very well. We posted an EBIT of 18%, which is in line with our desired recovery plan. It's a result of significant operational efficiency measures coming to fruition. We've got good billing rate improvements for all the higher-end services that we are delivering to our customers, and our fresher deployment is on track, and we continue to leverage a good fresher training and deployment engine. It's very important to note that this quarter we had a wage hike impact close to 90 basis points. So we've offset the wage hike, and then we've delivered a 1% improvement in margin. It's actually 133 basis points improvement in margin in the services business. So effectively, we have improved by about 230 basis points. Of course, about 50, 60 basis points helped by the currency, but all around we have seen a good improvement. Our bookings have been very strong, $2.4 billion in the last quarter, 11 large deals in services and products. Our bookings grew 6% on a total contract value, but on an annual contract value, it's 23.5% growth on a year-on-year perspective. Our pipeline is very strong. It continues to be at the higher end of all the numbers that we've had in the past. We also won a mega deal this quarter. There will be minimal impact of this deal in the rest of the 6 months, but it will start flowing in FY24. That's where the revenue conversion will happen. We also had some good client additions. We added 2 customers to our 100 million category, 19 and 30 in the 50 million, 20 million, and 10 million categories on a year-on-year basis. Our headcount growth was also strong. We added 8,359 net additions to our family this quarter, while we added about 10,339 freshers this quarter. This is the highest ever fresher addition that we've had in our history. From a segmental perspective, as I said, ITBS were leading in the overall growth with 5.3% sequential growth, and engineering services at a 5% sequential growth. Verticals and Geos, just to remind you, from Q1 FY23, we've been reporting the verticals and the geography for the services business and product business separately. So the split of the growth geographically for the services business is 6.9% sequential growth in Europe on a constant currency basis. Americas 4.7% sequential growth, and rest of the world about 3.5%. In terms of verticals, manufacturing grew 10.9% sequentially, and the energy, public sector, and energy and utilities grew 6% sequentially in constant currency. Across the board, all verticals have demonstrated strong sequential and strong year-on-year growth. In fact, our telecom vertical has grown 27% year-on-year, and our tech services vertical has grown 26% year-on-year, and all other verticals have also shown strong double-digit growth. That's pretty much what I had. Before I ask Prateek to share a little more detailed financials, I want to just give you a little commentary on what we are looking ahead. We remain very positive of our near-term growth and the medium-term growth. This confidence is coming from the booking that we've had in the first half of this year, and also the quality of pipeline that we have for the remainder of the year. This confidence is in line with the spending patterns and the trends that we see in the industry. We are guiding for 13.5% to 14.5% growth. We were earlier at 12 to 14. Now we are upping the lower end of our guidance from 12 to 13.5, and the upper end of guidance to 14.5. We're also providing specific guidance on our services business, which we expect to grow from 16 to 17% in this year on a constant currency basis. In terms of operating margins, we are guiding between 18 and 19% for the year. Given that one half of the year is complete, the 2% guidance range, we are narrowing down to 1%, both in total revenue, services, and the EBIT margins. We continue to see good momentum in the market. Our win with some of the large clients and scaling of some of the large clients that we won over the last 2 years continues to be very impressive. So finally, best wishes for the festival season ahead. Wishing all of you a very happy and prosperous Diwali in advance. With that, I will give it to Prateek to share more details.
Thank you, CVK. And happy festive season to all of you. Yeah, bang in the middle, started with the Shera last week, etc. Give you some more color on the numbers. In rupee terms, we closed the quarter with 24,686 crores of revenue, which itself is a growth of 19.5% on a year-on-year basis. And even sequentially, Q on Q, it is a 5.2% growth. And growth was led by services, which grew at 5.3% in constant currency sequentially, and 18.9% in year-on-year in constant currency. And even at a company level, HCL Tech overall company level, we delivered 3.8% sequentially in constant currency and 15.8 on a year-on-year basis. Our EBITDA came in at 22% for the quarter, and EBIT was at 18%, which is an improvement of about 100 basis points despite the salary increase. This was driven by largely 4 improvement factors: utilization of the manpower that we have already deployed and hiring, the pyramid that we operate with, also getting better realization from our customers, both from existing renewals and renegotiations, etc., as well as better rates from the new deals that we have signed in the last, say, 1 year, etc. And of course, helped a little bit by the Forex, though the Forex on the USD INR gave us more, but then cross-currency took away a lot of what that gave us. In terms of booking, we've already talked about 2.4 billion, 6% growth year on year, but it's a 16% growth sequentially, quarter on quarter. And ACV grew 10% quarter on quarter and 23.5% year on year. The mega deal that we spoke about, the great thing is that we got entry into that customer simply because that was a customer that came to us through the PNP acquisition, which we did about 3 years back. So this is a great validation of the synergies that we are deriving from that acquisition. We would probably not have even got the invite were we not on the roster of vendors with that customer. The better account mining through the year has delivered 2 additional customers in the $100 million bucket on a year-on-year basis, 15 to 17. And similarly, on a 50 million bucket, that number has gone up by 1 customer. Moving on to cash generation, cash conversion as a percentage of net income, etc. We delivered OCF, operating cash flow, of $2.05 billion over the last 12 months, and a free cash flow of $1.82 billion, which is respectively 114% of net income and 102% of net income as far as FCF is concerned. Balance sheet remains strong, getting stronger. Gross cash is now at $2.3 billion after the impact of Forex conversion, which obviously most of our cash is held in Indian rupees, so that had an impact, but still we have grown it quarter on quarter by about $41 million. And net cash at $1,765 million. From a shareholder's perspective, the diluted EPS for the last 12 months is at almost 51 rupees, 50.94 to be precise, which is an increase of 3.7% year on year and 1.8% sequentially. The dividend has been declared by the board at rupees 10 for the quarter, same as last quarter. And the record date for that is 20th October. And the payment date for the same will be 2nd of November 2022. With that, I would like to hand over to Rahul.
Yeah, thanks, Prateek. First of all, warm welcome to all of you. Extremely pleased to be taking on the role of the Chief Operating Officer for the corporate functions. As CVK mentioned, with our new branding, we are positioning ourselves for supercharging progress, and we would like to supercharge progress, for our clients, for our employees, for the communities that we are in, as well as for the planet. And we believe that as we enable these processes to happen, our enterprise functions need to work in a more coordinated manner, and to also reduce the friction that may be there today in our services to our employees and to our clients. I believe the role that I will be taking on will help to eliminate some of the friction by bringing these functions together. We've already launched a couple of programs in all our enterprise functions, whether it's marketing, whether it's finance, whether it's HR. I'm sure I will talk more about that, which will enable us to be more employee-friendly in terms of the services and more client-centric as well. And it will enable us to scale up in line with the vision that we are expressing through our new branding as well. So with that, I'd like to hand over to Ram to talk more about the people function.
Thanks, Rahul. Good evening, everybody, and a very happy festive season. Like Rahul said, I'm also very excited to take on the role as a Chief People Officer. It's week 2. Feels like I've already spent a lot of time, number of good ideas to get started. We have a very strong employee value proposition and a very clear charter. I'm looking forward to driving that charter. I'll talk more about some of the details when we get into the Q&A, but overall, exciting times.
Yeah. So over to Jill to share a little highlights about our brand transformation.
Great, thank you. Well, first of all, you can see that we are all embracing one of the 2 dominant colors of our new brand, purple, which is a nod to power and ambition, and leaning into HCL, our parent, which is a nod to stability and trust. So there is a little HCL Tech Supercharging Progress on these shirts, and I think it's fantastic that CVK recommended that we all come in with a strong united front representing our brand. Makes me very happy. We've been about 2 weeks out from our launch date of late September. You will have seen a lot of the video from some of the employee celebrations around the world. And Rahul just mentioned that we are really focused on supercharging progress for our clients, our people, our communities, and our planet. And we've got a really strong purpose that's very related to that. And that is to bring together the best of our people and technology to supercharge progress across all of those audiences. Our people are superchargers for our clients, but our people are also going to be recipients of the great work that Rahul is going to be doing in his new role to really help create a more frictionless employee experience and really drive things forward across our now 220,000-ish people. So I'm thrilled to be here with all of you. This is just the beginning of our journey, and you're going to see a lot more fantastic things off the back of our brand transformation.
Thank you, Jill. Now we will open it up for any questions with the audience who are here, and then we will go to the audience who are on the phone. Yeah. Okay, sure.
Good evening. I have a series of questions. Should I address them one by one to you all or ask one at a go?
You can ask them all at a go. So
This is Jill started with purple. Let me start with that. So beyond the purple toga of Julius Caesar, I really wanted to ask you, when you do this brand campaign, Rahul, specifically to you, could you give me a little bit more color on what you're planning to change? Is this an organizational revamp? Because if I look back at Facebook, when they named themselves Meta, they had a pretty clear direction on where the company wants to go next. You all are doing some of the things in business transformation for clients. So I want to know what this branding means in terms of your friction in the organization, and in terms of making it smoother, in terms of getting closer to clients. So that's question one. The other thing I want to ask you is, if I look at your numbers, your IT and business services is about 73.6% of your revenue. So I want to ask, there are concerns around the world of a global economic recession. I know that you've given a strong commentary, there's a strong pipeline that you have spoken of. But can you, if there is, we're almost waiting for an energy crisis in Europe. So if some of those crises do happen, then can you leverage your products and platforms and engineering and R&D businesses to offset the loss in the IT and business services business? Especially, we spoke about telecom, right? So we're also rolling out 5G here. This is a small market here, but even in other countries where you do more of engineering and products. So that, and also in terms of attrition, I wanted to ask, do you think this is going to ease? Do you think this is the high that it is around? Do you think things could get better from here on? So those are some of the questions. I think I'll leave it to you because otherwise I'm going to forget what I asked.
Sure, sure. You want to start, or Jill, you want to start on the brand and then?
Yeah, I mean, unless Rahul has anything to add, just related to his role first.
Yeah, I mean, see, when I spoke about friction, it's not that we don't have great services. We already have great services, but as we look at the future, we are going to be having more Gen X and Gen Alpha people who are, kind of born in this millennial as a part of our employee pool, right? So the expectation in terms of services, instant availability of lots of things and so on and so forth is some of the things that we want to provide to them, so that we are a better employer brand as well, right? So I think that is from the employee perspective. So far as the clients are concerned, of course, all our service lines are charged up, as you would have seen from our quarterly results CVK just spoke about. We want to make sure that they see us as a value creator, add no value, and enable supercharging their businesses, right? So that is the way our positioning is. We already have many cases of that type. We want to do more of that going forward. Jill, you want to add something, or CVK, would you like to add?
No, I think that's pretty much a very high-level summary. Maybe I'll go to the next question, which is on the overall business outlook. I think currently there is demand for tech services continues to be very high. I strongly believe it's still a supply-constrained market. There is enough demand for tech services because for every business, technology is so fundamental. And what technology can do is such a big priority for them. So I think if you are positioned to deliver the right set of services, which are mission critical for your clients, which are transformative for your clients in terms of their business outcomes, then I think we have a very good value proposition. So whether it is in IT and business services or engineering services, we have those strong value propositions. Like we run mission critical technology infrastructure for almost 200 of the top 500 companies in the world. So that is mission critical, right? We are focused on operating model transformation for a number of customers, IT operating model, which is aligned to the business operating model, right? And in the engineering services, we are accelerating product launches. And for almost half of the top 100 R&D companies which are investing in R&D. So all of this is what is giving us confidence. We've had a very good first half. We've had excellent bookings in the first half, which will result in good revenue growth in the upcoming quarters. And the overall pipeline and the visibility that we have for the next year will be reflected in the exit numbers for this. So all of this looks good. We are cognizant of the external environment, but we are focused on our clients, the opportunities that we are pursuing and how we can execute. And that gives us all the confidence to take this forward. Thank you.
Sorry.
Yeah, you can go ahead.
I think the supply side question still remains, right?
Yeah. What is
There was a question on attrition.
Yes, that's right.
Go ahead.
So I think attrition, we are in a good space now. If you look at previous 4 quarters, you would have seen every quarter there's been an increase in attrition. Whereas if you look at the reported numbers this quarter, it's pretty much platted out, same as what we had last quarter. So it's already stabilized. And that is the early indication of where we are in terms of what we look forward to from here on. So we're in a good place there.
This,
Hear me? Yeah. If I may just add, the quarterly annualized attrition has seen a significant drop quarter on quarter. So that's how, even though, it's a last 12-month metric that we publish, it would have otherwise gone up. But the reason it is flat is because quarterly annualized attrition has come down quarter on quarter.
this is Momita from PTI. I have a couple of questions. First is, what are your clients telling you about 2023 budgets and IT spends? What are you hearing from them? Second, how do you brace yourself for the, against these recession-related concerns? Are you going to be more cautious about your hiring from here on? And I think no conference nowadays is complete without a question on moonlighting. So I'm going to ask you that as well. What is HCL Tech's position and stance on moonlighting? How big an issue is it? And how are you sort of, ensuring those checks and balances are in place?
So maybe first I'll address the first question about the client spend, and then Ram will address the question on moonlighting. I think customer spend for FY23 it's still very early days. I think the budgets will get finalized towards the end of the year. By the time they share with us, it'll be early next year, the calendar year. So it's too early to comment. But I would think customers continue to prioritize some of the mission critical work and the transformation work that we are doing. So we feel confident that many of the programs that we're working on will continue to be very, very important and will get priority with our clients. We don't have an exact fix on directional view on the budgets for next year, but at an overall macro level, we think the tech spend will continue to remain robust. Even if you look at the Gartner numbers, all of that, it will continue to remain robust. And it's a very big market. You can always find the right opportunities to grow. Moonlighting is a very interesting and much talked about topic, and I'll get Ram to provide our perspective.
Dual employment while working for HCL Tech, we don't approve of that. I think everybody who signs up to work for HCL Tech is signing up an employment contract which requires exclusivity. There are requirements around confidentiality and non-solicitation, non-compete. All of those provisions that are there, we expect our employees to honor those commitments that are contractually made to HCL Tech. So dual employment while working at HCL, that's not what we support. Now, having said that, people do have personal interests, personal hobbies, personal preferences. Somebody wants to pursue that in their free time. That's something, we'll leave it to individual choices. That's our position.
Have you found employees who were working parallelly full-time with another company, and have you taken any action against them? That's the first question. And also a related question on employees would be, what are your plans on getting employees back to workplaces, which seems easier said than done?
So to your first question, fortunately, we don't have that as a big problem that, we have too many people doing dual employment. That's not a big problem. We've had one or two stray instances, and that we investigate and take action on, which we have done. But as I said, it's one or two stray incidences. It's not a problem that we experience. To your second point about return to office, we have adopted the hybrid operating model, and that's our go forward position as well. We have encouraged people now to come and work from office for at least 3 days a week. We have not initiated that as a mandate to begin with, but we have started encouraging people. We do as much as what we need to do to try and encourage people to come back. But the way we have tried to manage it is to empower our project managers who are better equipped to decide what makes sense for their projects, their deliverables, and their client commitments. And it's managed in a decentralized way from that point of view. The footfall is increasing. From where we were to where we are in the last 3 months, we've seen significant increase. So that trend is going to continue.
Is there any resistance from the workforce on coming back to office physically?
I wouldn't say there is resistance. People have questions, wanting to understand what this hybrid operating model will mean. And I think it's important for us to explain to people what it means and how it's going to help them have flexibility. At the same time, we're able to meet our client commitments. And it's a fine balance that we need to do, which is why it's important to get it done at the project level rather than trying to do it at an enterprise level. So it's a case of articulating what our position is and why it's important for people to follow that.
But you haven't put any targets in place saying that
so much portion of your employees need to be at office within this period of time, let's say next 1 month or so?
So we haven't set that out as a target at an enterprise level, but as I said, at every project unit level, we are moving towards 3 days a week at work. Now, at the leadership level, that is something which we expect that people will do. So our leaders do come in at least 3 days a week. That is expected. Again, not put out as a mandate, but that's a clear expectation at the leadership level. Otherwise, at the project level, it's managed by empowering the managers in a decentralized way.
Just want to also add, I think the operating model has changed forever. It's not going to be that people are going to come always to the office and work. So the world has changed. It is going to be hybrid operating model. We have reached out to our employees who are in so many different towns. In fact, we went to 20 small locations where we did not have offices. We had 500 to 1,000 people in each of those cities participate in those town halls. And I think what we recognize is the most important thing the work our employees are looking for. They want to deliver the outcomes. They want to have the flexibility to how they can deliver. So we are also convincing them about the opportunity to develop themselves by being in the office for 3 or 4 days. I think they're really appreciating the approach that we've taken. And I think we're continuing to deliver very high quality service to our customers in the current hybrid operating model. Thank you.
Hi, good evening, everyone. My name is Ashmit from CNBC TV 18. I have a couple of questions. The first one, there were recent brokerage reports which suggested that the net headcount additions that we are seeing after 7 quarters of continued additions saw a decrease in Q1, which was an exception. So this figure that you've shared, 8359 of net additions in Q2, I just want to understand that in context of sequentially, how does that look, and why, how does that look like, and what the trend in your expectation will be going forward on net headcount addition. And the second question I want to ask is that you mentioned that the number of freshers that were hired was the highest at over 10,000. Is this an exception? Is this something that you expect to continue, or do you expect some kind of moderation as had been suggested by the brokerage firm?
Yeah.
Additionally, if I can just ask one more issue, the issue of visas, that concern has been raised by the Indian Foreign Minister with the US State Department. That's affecting a lot of Indian players. How are you accounting for it? Is it affecting you on the issue of issuance of visas?
Yeah, a lot of questions. I think fresher addition, we added in the March quarter, the net addition in the March quarter, we had about 11,000 people, right? And the 2 quarters before that also, it was in the range of 10,000 every quarter. In the first quarter of this year, we added about 2,000 people. So that was really where we were building up capacity and people were getting utilized into billing. And now we've reached a certain scale on that we've again started hiring. So we've hired 8,359 people. So I think it's a good growth from what it was 2,000 to 8,000. It's about 4% of our headcount, about 220,000 people and 8,400. That's on the employee addition. In terms of freshers, usually the September quarter is the quarter in which you have the maximum number of freshers joining us. So I think that's why it is peaked at 10,000. We have a plan to get to 30,000 freshers in this year, so which we expect to onboard. And we have continued to onboard freshers. There has been no delays at all. Everybody is getting onboarded as per plan. Just want to clarify that. And visas, our approach historically has been to be less visa dependent. We try and recruit people in the respective geographies as our main talent sourcing model. And that continues to work well. And we've continued to grow our people numbers in all the geographies by local recruitment. And there is a little bit of impact due to some delays in visas, but there's nothing significant for us to report. Yes.
Good evening. I'm Saurabh from Business Standard. I have a question about
how is the global uncertainty impacting the pipeline of large deals? Another question is about IT services margin has dropped marginally this quarter, year-on-year basis. So do you think you will go for price hikes to safeguard your margins? And one more question is for Mr. Ram. By when do you see attrition rates going down below 20%?
Yeah, I'll start with the first question, which is large. Yeah, how is the economic environment impacting the deal pipeline? I think even the recession or even a concern of a recession is actually enabling a lot more transformation deals from our clients. A lot of our customers who are preparing for some kind of a slowdown are accelerating some of the things that they wanted to do so that they're better prepared for it, right? So it is with this backdrop, we find our pipeline is the highest. It's 20-30% higher than the highest. Even if I take out a large deal, it's still around the highest number so far.
Deals as well?
That's right. I think a pipeline is a mix of large and mid-sized deals and small deals. And we do see large deals in the pipeline, like we've announced one this quarter. So that's on the deals. And there was a question
On attrition.
on attrition.
So I think Prateek already alluded to it in terms of looking at the numbers. If you look at LTM basis, 23.8, which is same as what we reported last quarter. However, if you look at the current quarter on a quarterly annualized basis, there's already a significant drop. We expect that this trend of drop each quarter, we expect something is going to continue. So how many quarters it is to get to below 20%, it probably is not a prediction that I'm going to be making now. But we do expect the trend of dropping to continue.
Sorry, he had a question about margins.
IT services business margin.
Price hikes. And Ram, could I ask you if there are chances that, y'all are, last year when the crunch of IT services professionals was really high, salaries were being negotiated at higher levels. That also impacted margins. Is that still the case?
I think there are 2 or 3 variables that influence what happens on the compensation front. Attrition as a consequence of demand supply in the talent market is one thing. From a business point of view, demand continues to be robust. But from a talent supply point of view, I think there's easing of the demand supply in that sense. So as a result, we don't see the same level of pressure in terms of compensation negotiations, right? But having said that, we have also done what is right for our people. If you look at our practices now, whether it is in terms of pay increases in this cycle or in terms of how we manage our variable pay, even in the difficult times, we have stayed course in terms of sticking to our policy, right? We have had no change in our approach to variable pay. We have had no change to our annual compensation reviews as well, right? The only change that we have done in the annual compensation review this year is our top leadership team. We have deferred compensation by a quarter. That's like the remainder of the 98% of our people. They have seen their compensation increase in the usual cycles that they usually see. There's been no change. So I think it's also important that what we have as a policy and a practice, if it is consistent, more so in challenging times, I think that encourages people to look at the organization very differently.
Hi. Yeah.
Maybe I can just take sort of second question, right, on the margin. So you are looking at it, I mean, on a sequential basis, obviously there is a great increase of 133 bips on the overall services margin. But on a year-on-year basis, yes, there is a decline. And the reasons for that are primarily the increase in the average salary cost that we have, right? I mean, we also have a detailed cost by cost. You can also see it there. And that has been driven by what Sankalp was just asking Ram about, the compensation and the supply chain stress, let me just put it there. So I think strategically what we have done as a company is the best way to tackle it for the industry also. Simply by doing that musical chair churn more and more and more, we are all hurting each other. So that is why HCL Tech has significantly grown our fresher hiring engine. Over the last 3-4 years, we've almost increased it by 50% every year on the trot, including this year when we are saying 30,000. I think last year was about 22,000 or something like that. So that is sidestepping the churn in the lateral talent market, which was leading to all that. As that subsides or starts subsiding, like the QAA, quarterly annualized attrition, starting to come down, and by our whole fresher-oriented strategy, we are sidestepping and starting to see better outcomes on those two metrics. As I mentioned in my commentary on the margins, pyramid is therefore improved because we have so many freshers getting added every quarter. The utilization of those freshers as well as the laterals that we have has improved. And also we are able to get better realization for the services that we provide. So that is a sort of passing on at least a portion of the cost increase. So all these factors are combining to improve the margins. Yes, they continue to be lower than the previous year, but we are at it.
So, Debangana here from Money Control. I had a few questions. Firstly, because HCL Tech also hires a lot from offshore locations, what you call the new Vista locations, and also there's a lot of macro uncertainties going on. So, could you share your outlook on how the subcontracting costs are shaping up? What's the outlook for the next quarters? I think last quarter it had already started to trend down. That's one. Secondly, we have seen key financial institutions like Credit Suisse and Deutsche Bank getting impacted globally. So how does that impact the BFSI sector sentiments for HCL Tech's clients as well as from an industry perspective? Third, you said telecom is growing pretty fast for HCL Tech at 27%. Any plans or strategies around 5G technology since the launch happened? Any innovations that HCL Tech is working on?
Okay, maybe we'll start from the last question. It's easier to remember. So telecom, we are definitely doing very well, close to 27% year-on-year growth. And it's really primarily coming from our engineering capabilities, with which we help a lot of our telecom service provider clients in their transformation journey. And we also have some unique products, which we have modernized and upgraded. All of them will really play into this sector. So we continue to remain bullish for telecom. Financial services, of course, the two clients you named, we cannot comment on any client-specific information. But I can assure you that across the board, we don't have any impact. Nothing's come to our notice, and we don't expect. These are all clients where there's nothing. We don't have a big investments. It's already all services, so we don't foresee any risk from that perspective. And what was the first question? Yeah, sentiment. I think that's a point I made earlier, right? When you have recession, when you have a slightly difficult economic environment, technology is really an enabler in those scenarios, right? So a lot of cost transformation deals, a lot of modernization deals, which transform the tech landscape. At the same time, it reduces cost. I think those are the ones which are very hot. So we think that's one reason why pipeline is at an all-time high. And you asked about smaller locations in India, which we call as New Vistas locations. In India, we already have 25,000 people in in New Vistas locations, and we will continue to scale that. It will definitely grow at least 5 to 10% higher than our overall headcount growth.
Any timeline for that growth?
Basically, every year, if our headcount is growing, let's say 15, 20%, the New Vistas locations will grow 25, 30%.
Okay.
It's an annual number.
You also had a brief question about subcontractors.
Yeah.
So that is data that we have shared. It is at 15 point. It is total outsourced services spend is at 15.3% this quarter, wherever it is. It is a reduction from the last quarter, and it was 15.3. It's come down to 15 and is virtually the same as September quarter last year. So it's well under control. It had gone up a little bit, which has come down.
Yeah, I think we have taken enough questions. We are also running out of time. If there are one or two questions from the audience on the virtual channel.
Yeah, sorry, I just have one question. Shovik Das from Mint. Regarding the technology services and telecom expanding, and with 5G also coming in, do you expect new markets around the world beyond the Americas and Europe, which need an upgrade in the infrastructure, would be an attraction for HCL for new business avenues?
Yes, absolutely. We believe some of the products and solutions that we have are very well suited for all the international markets. And because of our presence in the telecom product business, we are pretty much present in some 100 plus telcos in some way, servicing them, or they're using our products. So that's again an opportunity for us.
Right. So do you have a projection for how maybe the rest of the world market share would increase, or how either of technology services or telecom would increase in the coming quarters?
We don't give a geography-wise projections. Everything is included in our overall guidance of 13.5 to 14.5% growth.
Thank you.
Thank you.
If you don't mind, just one more question. Oyanti from Informist Media. I just had one question about deal wins this quarter. So deal wins have marginally increased this quarter, even though there are demand concerns. If you could give us some insight into what led to this growth in deal wins, and how do you see it go next fiscal?
I think I kind of covered it in my commentary earlier. I think if you are focused on the right value proposition, which is very critical for our clients, then the probability of the deal happening and we winning is very high. It's really fine-tuning our propositions in line with the current challenges that our customers are facing, or the current new initiatives our clients are embarking on. It's really just being in the right place at the right time with the right solution that makes all the difference.
Thank you.
Yeah, maybe a couple of them. We can't do more.
Audience who joined us on WebEx, may please raise your hand and we will unmute your line. Thank you.
We have a question from Romita. She has joined us on YouTube, so I will be talking about the questions. The first question is, how are European and North American clients' sentiments following the larger macroeconomic concerns? Are deal cycles closure getting longer, especially for manufacturing and retail CPG? Because you called out for a slowdown last quarter.
Sorry, it wasn't very audible, but if I could just guess, you're talking about the deal cycles in manufacturing and retail CPG segments in North America. Is that the question?
Yes, that's what.
Yeah,
Can we repeat now? If it's
No, I think I got it. So I think, see, there are certain type of spend which is really discretionary in nature, which customers can defer. So those things gets deferred, or there's a slightly longer time in those deal cycles. But usually they're small ticket sizes. But I think the large transformation programs, which we are already executing, they're all critical programs for our clients' business objectives. So I think that's one reason we don't feel any kind of slowdown. There can always be one or two sporadic instances where there is a slowdown, but that happens in any kind of market environment. So I think if I take a macro view, we have not seen any significant slowdown or anything like that. And I think a lot depends on what is the proposition that you have. And HCL Tech has got a very rich service portfolio, which helps in a growth phase as well as in a difficult economic environment. So kind of fine-tuning our proposition in line with the current operating environment is what is the winning formula, which is helping us win large deals. Yeah, one last question.
Yeah, so I'll just, there's another question from Romita, which would be the last question for the day. Have significant pricing improvement across projects? What type of projects are clients open to upgrade pricing?
Yeah, we've seen good improvement in our realization, which could be due to both better pricing from existing clients for the existing work, and also getting better pricing for the new business that we are winning. Roughly, it added about 100 basis points to our improvement in margins, was driven by realization improvements, and the programs where the skills are newer, higher end skills, the digital transformation skills. These are the ones where digital technologies, which are niche skills, is what we categorize them as. That's where we found it easy to get the right kind of rate increases in line with the wage inflation that is there. But I would say across the board, we've seen success, even in long-term contracts and even in some of the regular work that we do, because the cost inflation, wage inflation is there across the board. So we've been successful across the board. Some situations in a smaller way, in some situations in a meaningful way, to get realization improvements. Okay, so I think that's brings us to the end of this session. Thank you very much for these engaging conversations, and wishing all of you a very happy festive season ahead, and look forward to seeing you in January. Thank you, everyone.
Thank you.
Thank you.